Fellas, you know Degree Cool Rush deodorant, right? Well, last year they changed the formula, and guys were mad about it. One dude even started a petition. So guess what? Degree heard us, admitted they messed up, and brought the original Cool Rush scent back exactly how it was. And it's in Walmart, Target, and other stores now for under $4. So grab some and remember why its cool, crisp, and fresh scent made it the #1 men's antiperspirant for the last decade. Degree Cool Rush is back, and it smells like victory for all of us.
Hi, everyone. This is sort of a special introduction to today's podcast. This podcast is being posted on Thursday, the 24th of February, 2022. We recorded this podcast a couple of days ago before the events that occurred today. We thought about talking about the Russian invasion of Ukraine and what it might mean to you, but really, we've talked about it before, and we'd rather spend some more time on it and have more information, have a couple of days for the world to sort of digest what happened. I mean, we've already seen some of that in the markets today. So if you're wondering why we're not talking about the Russian invasion of Ukraine, it's because we're going to do it later. We'll probably do it this weekend on our live show, which airs on Northwest News Radio in the Seattle area, which is 1000 AM, 97.7 FM. And you can also listen. If you'd like to listen to Saturday's show live, you can do it at talkingrealmoney.com. Just scroll down the page, and we have a player there, an embedded player, or you can go to Northwest News Radio's website and listen to it there. You can also call in and be a part of that show. So we'll have a little more time. We'll talk about it then. And so for now, we're going to go back to our regularly scheduled program, which is a show that was recorded Monday or Tuesday. I lose track. I live in this room. I lose track.
Reality radio for a really great future. We're talking real money.
I'm disappointed in us. How in the world did we miss this big multi-billion-dollar basic rip-off stupidity story, a sales pitch gone bad story? I don't know how we missed this one, but I want to thank Pat, and Pat, you know who you are, for sharing this story with us, because I've had just more fun than I can stand. It actually took today and made it a better day, because there's nothing I like more than investigating the idiots in the insurance industry. And you at Allianz in Germany? Yes, you know you're a bunch of goofballs for this one. Not the brightest bunch in the bulb box. Okay. Anyway, here's the deal. Hi, welcome to Talking Real Money. We're going to talk about something really important today, and we're going to take a couple of your questions. I'm Don McDonald. I'm in my Florida studio, and Tom, with planes of all ages flying overhead, is in the Woodinville, Washington studio.
Yeah, here I am. And by the way, I'm a little underdressed today. I'm a little underdressed today because Don surprised me and I wasn't ready. So here I am. I'm going to do the best I can.
Excuse me, sir.
Be on the podcast.
When I called you this morning, you were eating breakfast in a T-shirt.
Well, okay, so that's a good point.
You could have dressed up.
That is very true.
Instead,
so this is me dressing up on the holiday.
You chose to pretend to be an Italian restaurant for the remainder of the
Maybe
episode.
I'm going to have a little linguine right after this is done.
Yeah,
throw it right
linguine
on
a Tom's tablecloth that is probably strobing like mad on most of your screens. So if it's making you go blind, blame Tom.
That won't be the first time.
Hi. Let's talk about Allianz, shall we? Now, you know, we have a basic distrust of insurance companies, just generally. And, well, this is kind of a lesson why. There was a story that came out recently about how Allianz was selling an investment called a structured alpha fund to institutional and high net worth investors. Now, this is a magic bullet fund, Tom. This is a magic fund. I think that they would have been better off if they called it the Magic Fund, because magically, this is from their sales material. It's a great way to set this up. Their investment philosophy: long and short volatility at the same time, all the time. Pursue gains, but do not presume the market will behave normally or history will repeat itself. An ability to perform irrespective of the market environment. We're going to make you money if it's going up or it's going down. Doesn't matter. Never make a call on the direction of the market. Doesn't that sound great? We're not going to try to predict the future. We are just going to get you, we're going to give you the upside, we're going to give you the downside, and that is in their three-pronged investment objective. 1, profit during normal market conditions. This is a quote, up, down, or flat. Protect against a market decline. The returns of the market, none of the risk. Who could ask for anything more? Negative, or not negative. See, I just thought negative. Navigate as wide a range of equity market outcomes as possible. So we're going to take every possible outcome into consideration to provide you, the pension funds of America primarily, with a tool that you can use to make money and take no risk.
Does it say how much
Thomas.
How much we're going to charge you for that, by the way?
I have no idea what the fees are because it was a private fund. You had to have $1 million minimum to get into the darn thing.
And most of the money, as you point out, was pensions, major institutions.
And they said, quote, we will protect your money, quote, in event of a market crash, including a severe downside market move such as Black Monday of 1987.
Or how about the COVID downturn of March of 2020? How's that?
Well, funny you should mention that. They had multiple funds. They had the Alpha 250 fund, the Alpha 350, and the Alpha 500. The 500 was supposed to make you more, the 250 make you less. And again, the protection was going to vary between them, but still, you were going to save money. Now, Tom, you remember the March decline of 2020?
Yeah, I mean, stocks went down. Stocks went down about 30%, and bonds made about 10%. I mean, it was year to date at that point. So in the first 3 months of the year.
So
quickly.
After that, though, didn't they end the year up?
In both categories, correct.
Yeah, it's funny how that works. So if you had just been in the market, if these institutions had just been 100% in stocks, at the end of March, they would have, for the year, been down about 30%. However, if they were in the most conservative, the Alpha 250 fund, well, their decline, their downturn, their loss by the end of March was a mere 43%.
Wait a minute, really?
Oh, wait, there's more. If you had the Alpha 350, you were down 56%. And if you had that high-flying Alpha 500, well, your loss for that first 3 months of the year was a mere 75% of your assets.
75. That does not sound like very pension-like returns.
No. Well, the good news is it's very complicated, but here's what they were trying to do. In 2019, they made some mistakes. They traded based on their research, maybe even their feelings. And they made some mistakes and didn't do well. So in 2020, they tried to recover. So what they did was they doubled down on a lot of their mistakes, and they sold futures contracts that in essence said, if the market goes down a lot, we will lose a lot, and you, the people we're selling this to, will be protected. In other words, they're selling their downside protection to other people. Well, when the market went down, they didn't just go down. They doubled down. More than doubled down. Went down more than double what the market did because of this stupidity. And it was stupidity. They actually made human errors. They had no system designed to protect you in up and down markets. No algorithm. If they had it, they didn't follow it. So they're being sued like mad.
By
everybody who bought the stuff from them. As a matter of fact, last year, they had to set aside $6.3 billion to cover the future lawsuits. And not dollars, euros, even more.
Yeah,
that's even more money. So they believe that the worst case scenario is that they're going to have to pay out 7.6 billion euros to investors that they took advantage of. So thank goodness the system is at least working after the fact. But, Tom, there's a lesson for all of us in this story.
Yeah, here are a couple of mine. First of all, I don't know where Allianz is on Volkswagen, but maybe Allianz should have an alliance with Volkswagen. They have a similar kind of company culture, feels to me. But anyway, setting that aside for a moment,
you just love the Volkswagen diesel story, don't you?
I will never get over that, literally, because you just hook something up. It's a lot like this investing story. You just hook something up in between the catalytic converter or something, cleans it all up, except when it does. Anyway, so it's very similar. So here's the thing. First of all, and we've talked about this on the show before many times. When I invest my money, it's with companies that are not in the insurance business. They are in.
No, wait. When you invest your money, you own companies in the insurance business.
Well, that's
true. But you don't invest with them. I just want to clarify.
I don't hire Allianz. I don't hire Valak. I don't hire people in the insurance business to manage my money. No offense to them. I'm sure they're wonderful. I'm sure they're very nice people. They're very nice people, Don.
I don't believe they generally care about their customers as much as they care about themselves.
So that's one. But here's the other one. And we know this because we have talked about this, decades. Every time you add complexity to your investments, a couple of things happen. Number one, generally liquidity is harder. In this case, I have no idea how quickly people are able to get their money back from this. Number two, inevitably, the cost is higher. We can't tell what the cost here is. And number three, it seems, and correct me if I'm wrong here, I've still yet to find the long-short fund with the that beats, that does better, that creates a greater return than just being in stocks and bonds. I've yet to see it. And yet, we're all searching for that. Investing nirvana. Somebody has to put this together for us, right?
And I always, when I think about this, I always come back to the story about Jack Bogle and the hedge fund manager. This should be a children's story. Jack and the hedge fund manager, told by the Brothers Grimm.
They got beans.
Because the ending is so grim for the hedge fund. The bet that over 10 years, a portfolio of hedge funds would outperform the Vanguard Index 500, which Warren Buffett
I think that was Warren Buffett.
Handily.
Yeah, you said Jack Bogle, but Buffett.
Oh,
right.
I meant Warren
big.
Buffett.
Big.
Thinking
wasn't even close.
One big. Because hedge funds, by their very nature, just because the way they're structured, and this is what this is, by the way, this is an Allianz hedge product. If it's trying to hedge bets, you either hedge the bet and take away some of the upside, or you take all the upside and you live with the downside. You can't have both. Period. Ever. 100% certain. Because of fees. Because there's no such thing as the performance of the market with none of the risk. It just doesn't work that way. And you have to realize it doesn't, and you have to start working toward your retirement goals in a sensible, planned fashion, understanding the realities. You can't have all these things you want to have. I'm sorry.
This is the you can't have wealth without risk speech.
Yeah. And we've given this a lot over the years.
Several times. Again, I think those are great takeaways.
And these were professionals who fell for this, Tom.
Yeah. Yeah, I mean, that's the other part.
These are professional money managers.
Yeah, the pensions, they have advisors, right? These large institutions, they have advisors that tell them, throw some of your money at this. So we're still waiting for the punchline, of course, because the lawsuits are underway. I don't think there's been a settlement, correct?
No, not yet. Not yet, but as Allianz says, it's probably going to be in the 7 billion euro range. That's a lot of dough.
It is. Even for them, it's a lot.
And I'm sorry, folks, here's the reality. You're going to have to accept the risks of the market if you want the returns of it. If you want a more conservative, safer portfolio, you must accept less money. Period. Thank you. 855-935-TALK. What?
Nobody wants to. Nobody wants to.
Of course not. When so many people are promising you whatever you want, they're lying to you. 855-935-TALK. That's our phone number for calls. You can call 24 hours a day, 7 days a week. We also take your questions at talkingrealmoney.com. And during some of these shows, we take the written ones, of which there are many, although we are up to the 5th of February now.
By the way, I answered one today for a gentleman who said the reason that he wrote it is not everyone has the radio voice of Don McDonald, so sometimes we like to type. So anyway,
I'm not trying to make people feel bad.
No,
I got this voice. I'm sorry.
He hooked up to a machine when he was 13. It stayed with him. Leave him alone.
It was part of the package, folks. I don't know. It was why I was able to make some extra spending money in high school playing the guy in the red thing with the beard. I know I don't look a thing like him, but yeah. With pillows you do. Hi, kids. Out. Welcome. Yeah, I even got to fly in the helicopter.
Speaking of making a lot of money with no risk, there you go. Getting free gifts, you got it. No problem.
It was not a lot of money. I'm thinking it's 1973. I'm thinking it was probably right around $2 an hour, maybe $2.50.
That sounds about right, by the way.
Yeah, was pretty pathetic. All right, so we're going to read a question, and Tom, who has never before heard this question, will attempt to answer it. Hopefully, we'll stump the Tom. That's what we're going to call this section of the show. Ladies and gentlemen, welcome to Stump the Tom.
That is not hard
to do.
Here we go.
You ready?
Okay. Yep. Mm-hmm.
Tom.
Yes.
I plan to retire this coming April and also sell my home. I have another home through a recent marriage. Well, there you go. We would like to sell that home too eventually, and we will use the sale of my home to bundle both together. I have a Vanguard IRA, Roth, and have transferred my Boeing VIP into a retirement IRA there too. My question is,
yes.
What? Oh, good golly gee whiz. What is a good holding fund for the proceeds from my home sale in Vanguard? Should I just set up the Vanguard Money Market Fund? It may sit there for a year or more, I expect. Appreciate any guidance on this. P.S. I had a Vestry blueprint provided in the past 5 years.
Oh, good. Okay.
Yeah.
But first of all, by the way, the Boeing VIP shall now, from this moment forward, be known as the Boeing 401k. That's official. So just putting it out there.
Wow, catchy new branding.
I didn't come up with it, but speaking of companies that have a little issue with public trust right now, but that's a whole other thing. So to that end, what should you do with them?
Yeah, I got to see that 737 documentary.
My son texted me about it yesterday. I've read. I don't want any more. But anyway, setting that aside, what should you do with money that you may need in a year? You know what? I mean, I am tired of recommending short-term bond funds because they've gone down. They've lost like 1 or 2 or maybe even 3% of their value, and people say, "Oh, that was a bad idea."
Really high there for a minute.
Well, I haven't been taking my Morgan Freeman lessons, so I'm tired of mentioning that.
I'm tired of mentioning bond
even
funds.
Though, for full disclosure, I still use them. I still do.
We get slapped around. We get slapped around all the time about bond funds.
We do. We should another show on bonds. But okay, so let's not do that right now because we're in a period of interest rate volatility, Don, where rates may go. Anyway, so
you're not backing down, are you?
I'm not backing down. I would still use that fund. That's fine. Here are your options.
What's the fund? Go ahead. What?
VFSTX, Vanguard Short-Term Investment Grade Bond Fund. It's yielding, I think, just a hair under 2, but I think year to date it's lost somewhere around 2.3, 2.4%. So don't buy it. Don't do it. Don't put there'll be a rush of money into that fund. Okay, here are your other options. Yeah, the money market probably, I'd have to see what the Vanguard money market's paying right now. Don will find that for us. It won't be much. How much?
I don't know yet, but oh my gosh, the yield on the VFSTX is 1.6.
Okay, there you go. It's close.
And it's lost 2% total.
Right,
so
there you go.
Basically the 1 point. So it lost 0.5% in the value of the bonds
in that period of time. And it may very well lose more as rates go up, if they go up. Anyway, because we don't know for sure what's going to happen. Number 2. Yes, you could use the Vanguard money market. I bet it's paying, half of 1%, 4.10. Anyway, so pretty small number there.
Hold on, I'm going to look it up.
He's looking it up.
You
could use a high yield savings account. I don't know. You didn't give us the amount, so sometimes people are nervous putting $500,000 in a savings account.
It's 6 figures.
Oh, it is. Okay.
Well, he's getting it out of the 2 houses, so It sounds like it's a lot of dough.
Yeah, so sometimes people are nervous there because the insurance only goes up to, I think, $250. But you could put it in several of those. You could go to bankrate.com, see the best deals. And I guess if you had to, you could buy a 1-year CD and get 0.4% or 0.3%, whatever it is. None of these things are paying much. And it doesn't really matter because you're going to use the money again in a year to buy something else. And I will hope for you that the housing market turns and goes completely opposite direction in the next year so that you can, A, find a house and B, afford one, because right now it's insane to even find real estate to buy. So what's the money piece? I can see a disturbing look on your face after finding out the money market amount. How much?
Oh my gosh.
What is it?
Really? Well, let's start with the Vanguard cash reserves.
No, okay, yeah.
Yeah, the cash reserves federal money market. That's really safe. It's in U.S. securities, government.
Yes.
Its expense ratio is merely 10 basis points.
Okay.
However,
the payout is
after its 7-day yield of 1 basis point.
1 basis point?
Your loss is guaranteed to be 9 basis points a year, even in a money market fund. You have a guaranteed 9 basis point loss.
Yeah, as I said, the options are limited. If it was my money, I would go to Bankrate and look around. Look at CD rates, maybe 1-year CD. Look at high yield
savings.
It's like 60 basis points or 50 or something like that.
No, I think it's 50.
It's a little more. Okay. Yeah.
And it's so funny that nobody is raising rates. That tells you how much they believe that rates are going to stay high. What that really tells you is that the banks and the market don't believe that the Fed's moving the shortest term interest rates is going to last for a very long time, or you would see rates starting to sneak up. Yeah, the highest rate. No, wait. Okay, great. I don't know. They're FDIC insured, but they'll probably be one of the next companies in a big downturn to get bailed out by the FDIC.
What? Which one? What?
Lending Club.
Oh, God. No, I would not give my money to Lending. No.
Well, no, but they're FDIC insured.
All right.
And they're paying 65 basis.
Yeah, but you could go to somewhere more reputable and make 0.5%. I mean, again, none of this is
American
really
Express,
be
National Bank, 0.5%.
Yeah.
Marcus, 0.5%.
I might do that, or do a little bit at Marcus, do a little bit American, have a few accounts if you're nervous about the FDIC insurance. So none of those options are great.
I haven't looked at a money market account in so long. Oh, well, here, let's look at this. This doesn't look bad. You can get into a 1-year CD.
How much?
No, you got to go 1.5 years to really get a decent rate. 1.5 years, you can get over 1% at Pentagon Federal Credit Union. 1.15.
I'm sorry, there are no great options for parking your money short term.
Colorado Federal Savings Bank is giving 90 basis points on a 1 year.
There you go. All right.
Trying to
help.
You
have to move to Denver or something? I don't know.
Trying to help. I'm going to give you one more because this one's really quick.
Oh, please. Yep.
Quick. A recent caller asked about where to keep international or emerging market international funds. Don answered better in a taxable account due to foreign tax credits, citing Christine Benz from Morningstar, who said the same thing. So what about VT? I hold it in my Roth. Is that a mistake?
No, I mean, again, in your Roth, there's not going to be any tax ramification anyway, and VT probably holds...
you can't use the foreign tax credit.
Yeah,
but it's not going to be huge.
I mean, if you're Carl Icahn, you might be worried about the foreign tax credit. For you and I, it's not something I worry about year to year in terms of my taxes. There are other things you could do to be more tax efficient. So no, I wouldn't worry about that. And VT still does a very good job of covering the globe. You get, 8,800 securities. You get it at a very low cost. And I think it's a good fund for most people. And I think in the Roth, it's a great place for it.
And I got to tell you, I get kind of frustrated sometimes because we all get caught up in the minutia. I mean, really, we're talking about when you get to these kinds of numbers, unless you have a multi-million-dollar account with Vanguard, it's not even going to be in the thousands of dollars. It's going to be in the hundreds or tens of dollars for smaller accounts, and we're quibbling over pennies most
pretty
of the
close.
time.
Mm-hmm.
So no, it is not a mistake. But generally speaking, if you keep your foreign funds in a taxable account, you'll get a little bit of a tax credit that can help your bottom line because it is a credit, but it's not going to be huge because you're not going to have a lot of foreign taxes paid out of most mutual funds.
Correct. Yeah.
Not a big deal.
I'm trying to remember if it even shows up on my return, which I don't think it does.
Well, I am trying to find it.
I could go look, I guess, but
yeah, it's. I'm just looking. It's about, the credit is about 7% generally in a 100% foreign fund on an annual basis is about 7% of the dividend.
Yeah,
on
only
the fund.
of
now,
the
remember,
payout. Correct.
Stock funds don't have big dividends. They might have maybe 1.5% or 2%, maybe at the high end. So you're only talking about 7% of that. So we're talking, oh my gosh, tiny little numbers. Tiny.
7% of 2. That's pretty small.
Yeah. Thanks for being a part of the show, the podcast. Please tell your friends, your neighbors, your relatives, people you hate even. Maybe you'll make their life better and you'll stop fighting. If you love what you hear, leave a podcast review on Apple Podcasts, or you can rate us on Spotify. Share on your social media. Like us on Facebook. Subscribe on YouTube.
You forgot
Follow
one major
us on
one.
Apple Podcasts. What? I'm trying to think of them all.
No, you left off the biggest one. If you want help, let us know.
Oh, I leave that one to you. Go ahead.
Oh, I see. Okay, I'm that guy. Okay, fine. Okay, I get it.
Yeah, you're the pitch man.
I knew that was coming. If you want help of any kind. We talk to young people. Yeah. We talk to middle-aged people.
Homework.
We talk to old people.
You got a jigsaw puzzle you can't solve.
No, I'm better with models.
Trying to do Wordle.
That's true. Don,
he knows all the 5-letter words.
I'm better with the 4-letter ones. Listen, okay, so if you need help, reach out. Can I say that? Reach out and touch someone? Okay, maybe not. Anyway, you go to Vestory.com. You can make an appointment for the time and day that works for you, right? Any of those.
Sure.
So, and we talk to anybody over about any issue, and we don't pitch you, and we don't pitch you. I'm missing something there. We don't pitch you. There was
you're good.
Anyway.
No obligation.
No obligation.
No
That's
cost.
it. Yeah.
No
we want to
high-pressure
help.
sales pitch. Yeah.
We really do. So take advantage of that.
Can we go now? All right.
Absolutely free. Yep.
Thanks for watching. Thanks for listening. I'm Don. Tom's over there. We're going to go back into our little room somewhere and research and read about, and then, if we're very lucky, talk real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial product or securities. Instead, the program is provided as a public service by Appella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. To keep the lawyers happy.